The biggest fortunes in trading history were not built on diversification. They were built on concentrated, audacious bets. Conventional market wisdom dictates that capital must be spread across various assets to mitigate risk and protect against single-stock failure. However, Jesse Livermore, the greatest speculator of all time, fundamentally rejected this idea, asserting that diversification is merely a hedge against ignorance. His entire methodology centered on the principle of treating capital not as a safety net, but as ammunition reserved only for the clearest, highest probability setups. Livermore's core thesis was that if a trader has done the necessary homework, identified the major trend, and waited patiently for the optimal entry point, scattering capital across multiple stocks dilutes the potential reward. He believed that true conviction, backed by meticulous analysis, demanded concentration of resources in the strongest areas. Spreading funds thinly across inferior setups ensures mediocre returns, even if the overall portfolio survives minor shocks. The anti-diversification rule is therefore the practice of maximizing leverage on absolute certainty, not generalized hope. Before we delve deeper into how Livermore implemented this risky strategy, please take a moment to subscribe to the channel and leave a quick comment below. Even just a single word or emoji helps the algorithm tremendously and ensures this specialized content reaches more serious traders who need it. This simple action shows me that this kind of historical and strategic analysis truly matters and is worth the extensive effort required to create it. And remember to return to this channel during challenging times, especially when trading becomes difficult and your confidence starts to waver. Livermore understood that the market offers very few genuinely high-probability opportunities in any given year, perhaps only 3 or 4. Most of the time, the market is simply consolidating or moving without clear direction, making large commitment reckless and dangerous. The anti-diversification rule mandates saving capital during these periods of uncertainty, allowing the trader to maintain maximum dry powder for the inevitable breakout. When the undeniable trend finally manifests, the trader is ready to commit a substantial portion of their working capital to that single dominant idea. This approach stands in stark contrast to the modern institutional mandate of risk parity and broad asset allocation prevalent today. Modern portfolio theory is designed to protect large institutions from massive drawdowns across thousands of client accounts, not to generate explosive generational returns for an individual speculator. The individual trader, unburdened by fiduciary limits and client expectations, possesses the unique advantage of being able to concentrate capital powerfully. Livermore utilized this advantage ruthlessly, recognizing that his goal was profit maximization through focused aggression, not risk minimization for a large client base. Livermore's concentration was not reckless gambling. It was calculated aggression based on deep market structural analysis and tape reading. He was only willing to bet big on one stock or sector when the technical and fundamental conditions aligned perfectly, creating a clear point of least resistance. He waited until he was absolutely certain that the market was going to move substantially in one direction, thus justifying the massive capital commitment. This precision waiting game is what separates strategic concentration from mere speculative chance. The danger lies in misunderstanding the context and prerequisites of concentration, which often leads amateurs astray. A novice trader committing 80% of their capital to a random stock based on an internet rumor is committing ruin, not following the Livermore method. Livermore's conviction was derived from observing market action, deep tape reading, and a profound understanding of human psychology, which he knew drove prices relentlessly. His concentration was a reflection of his confidence in his analysis, not an attempt to force the market to move in his favor through sheer size. The central claim underpinning his philosophy is simple yet terrifying to most modern investors. Diversification protects against ignorance, while concentration capitalizes on absolute conviction. If a trader feels compelled to diversify widely, it often signals a lack of faith in any single idea or an inability to identify truly superior opportunities. To bet small on 50 different ideas suggests that the trader believes 49 of them are likely to fail or produce only marginal returns in the long run, Livermore demanded that his capital only be deployed where the probability of success was overwhelmingly high and the potential reward was commensurate with the risk taken. The technical requirement for concentration, according to Livermore, was finding the precise point of least resistance. This is the critical moment when all market forces, volume, price action, and overall market sentiment, align to suggest an inevitable, sustained movement in one direction without significant retracement. He would not enter a large position prematurely, waiting instead for the market itself to confirm his initial hypothesis through a decisive breakout or breakdown on heavy volume. Entering at the point of least resistance minimizes the time spent waiting for the trade to move, which is extremely critical when large sums are involved and carrying costs are high. Concentration required a degree of patience that lasted weeks or even many months while waiting for the perfect confluence of conditions and market events. Livermore was famous for sitting idle, sometimes for half a year, holding on to his cash until the market presented the exact structural conditions he needed to deploy capital. He viewed this waiting period as essential preparation, ensuring his capital remained intact, liquid, and ready for deployment when the signal was unambiguous and clear. The true skill lay not in trading frequently, which is often the amateur's mistake, but in trading correctly and maximally when the time finally arrived for a major move. Crucially, Livermore did not begin his concentrated bet by risking everything on the first entry point or at the first sign of movement. He meticulously detailed his specific scaling methodology, which served as a critical built-in risk management layer for his anti-diversification stance. He would initiate a trade with a small pilot position, often just 10 or 20% of his intended total position size. This pilot position acted as a preliminary test of the market's immediate reaction and confirmed the fundamental validity of his initial entry point and timing. Only after the market proved the initial analysis correct, pushing the pilot position into a substantial profit, would Livermore begin to scale up his commitment. He would add to his position incrementally as the price moved favorably, using the paper profits already generated to justify the increased exposure and risk. This methodology ensured that the bulk of his concentrated position was established only when the market was already validating his decision, effectively reducing the risk on the entire overall trade. The process of scaling was systematic, never emotional, and always followed confirmed, rising price action, never anticipating it. If the initial pilot position immediately went against him, he would exit immediately, suffering only a small manageable loss, and the full concentrated bet would never materialize. This disciplined, incremental approach meant that his betting big only happened when the market was already paying him to take the risk by moving in his favor. Scaling into a winning position is the hallmark of the professional speculator, contrasting sharply with the amateur who averages down on losing trades. The necessary counter-rule to concentration is the absolute, unflinching refusal to average losses under any circumstances. This rule is non-negotiable for the speculator, and its violation is what turns the powerful strategy of concentration into a swift and brutal path to ruin. If a trader commits a large percentage of capital to one stock and that stock begins to fall, adding more money to lower the average cost is simply throwing good capital after bad. Livermore learned this fundamental lesson through painful multi-million-dollar failures early in his career when his youthful ego was still unchecked. Concentration is only a safe and viable strategy if the trader adheres rigidly to a predetermined stop-loss, treating it as an inviolable command established before the trade begins. The moment the market invalidates the initial premise and the price crosses the stop-loss level, the entire concentrated position must be liquidated immediately, regardless of the size of the resulting loss. Averaging down transforms conviction into desperation and hope, trapping the trader in a cycle of denial that ultimately destroys the capital base needed for the next high-conviction opportunity. Livermore summarized this crucial principle with profound clarity and conviction. It is not wise to distribute your money among many stocks. He viewed the act of distributing capital widely as a tacit admission that the trader lacks the fundamental confidence to identify a truly superior opportunity. Why commit small, insignificant amounts to 20 different stocks when one single stock offers a 5-to-1 risk-reward ratio based on deep, penetrating analysis? The answer is usually fear, not wisdom. This concentration principle forced Livermore to be incredibly selective and supremely patient, a necessity that disciplined his entire, often reckless trading process. He knew that the moment he decided to concentrate, his analysis had to be near flawless, and his execution had to be immediate and surgically precise. The enormous risk associated with concentration served as a powerful, necessary filter, forcing him to only engage when the setup was truly exceptional and market dynamics were overwhelmingly in his favor. The strategy of betting big on one stock or sector is fundamentally a strategy of opportunity cost maximization, a concept often overlooked by diversified investors. Every dollar allocated to a mediocre trade is a dollar unavailable for the truly massive, life-changing move when it finally appears. Livermore treated his capital as a scarce, finite resource that should be conserved and deployed with surgical precision, maximizing the impact of every single successful trade executed. Furthermore, concentration allowed Livermore to focus his emotional and mental energy entirely on managing that one single dominant position. When a trader is diversified across 20 different stocks, they struggle immensely to monitor the specific news, the complex technical patterns, and the volume dynamics of each individual asset simultaneously. Concentration provides unparalleled clarity and allows the trader to become intimately familiar with the specific price action and internal rhythm of their singular, high-stakes bet. This deep, focused attention is absolutely crucial during periods of high volatility and uncertainty, where quick, decisive decisions are required to protect capital from sudden shifts. Livermore could dedicate all his cognitive resources to analyzing the tape of his primary position, enabling significantly faster reaction times and infinitely better execution of orders. The dilution of focus that inevitably comes with extensive diversification often leads to missed signals, delayed responses, and poor execution across the entire portfolio. The concentrated position must always be established in alignment with the major underlying market trend, a rule Livermore never forgot. Livermore was a trend follower above all else, understanding that fighting the primary movement of the market, even with a concentrated large bet, guarantees eventual failure. He would look for stocks that were clearly leading the overall market movement, either strongly up or strongly down, confirming the undeniable path of least resistance. If the general market sentiment was overwhelmingly bearish, he would concentrate his short positions on the weakest stocks in the most vulnerable sectors, maximizing the velocity of the decline. Conversely, if the market was trending strongly upward, he would concentrate his long positions on the clear market leaders, showing superior relative strength and momentum. This powerful synergy between the concentrated bet and the market tide amplified his returns significantly and reliably. It is important to remember that Livermore's strategy was inherently designed for capturing large, sustained moves over extended time frames, not scalp trading or short-term volatility plays. His concentration was aimed at riding a major trend for many weeks or months, extracting maximum exponential profit from the structural shift in the market dynamics. This long-term structural perspective allowed the concentrated position to mature and realize its full, life-changing potential, rather than being prematurely exited. The trader attempting to replicate this concentration strategy must first absolutely master the art of identifying these macro shifts and structural biases in the market. Without this foundational understanding of market mechanics, concentration becomes merely a high-stakes blind gamble with poor odds. Livermore's incredible success was ultimately rooted in his ability to read the underlying mechanism of the market, identifying whether the current cycle was one of systematic accumulation or widespread distribution. Speaking of mastering market structure and deep analytical work, understanding the foundational principles of contemporary figures like Richard Wyckoff offers immense practical value. Wyckoff's methodologies provide a systematic, rule-based framework for analyzing market cycles, specifically identifying the critical phases of accumulation and distribution that underpin all major price movements. This rigorous analysis helps traders gain the absolute conviction needed to attempt a concentrated bet, ensuring they are not just guessing based on emotion or rumor. We highly recommend exploring dedicated educational resources like the Richard Wyckoff Trading Methods channel, which offers deep dives and practical breakdowns of these essential concepts and patterns. Learning to read the market's internal dynamics, exactly as Wyckoff taught, is the necessary prerequisite for achieving Livermore-level conviction and discipline, so check out the link in the description to start your journey into systematic market analysis today. Livermore's concentration was therefore the well-earned reward for perfect patience and meticulous, exhaustive preparation before the trade. He earned the right to bet big by eliminating nearly all other possibilities through disciplined weighting and rigorous filtering of ideas. The sheer size of the concentration served as a powerful amplifier, ensuring that when he was right, the profit was life-changing and exponential, justifying the long periods of inactivity and the small losses incurred during the testing phases. The most famous and dramatic illustration of Livermore's concentrated strategy occurred during the catastrophic panic of 1907 in the United States. The market environment leading up to the panic was characterized by rampant speculation, overextended credit, and dangerous pervasive fragility within the banking and railroad sectors. Livermore, with his keen sense of structural risk, recognized the inherent weakness in the financial system and began positioning himself for a substantial downturn, conserving his valuable capital for the inevitable crash. As the panic began to unfold rapidly, triggered by the spectacular failure of the Knickerbocker Trust Company, Livermore realized the path of least resistance had become overwhelmingly bearish and undeniable. He did not scatter his capital by shorting hundreds of random stocks across the New York Stock Exchange in a generalized panic. Instead, he focused his entire massive short position on a handful of vulnerable sectors and specific high-flying stocks that were heavily indebted and technically weak. His primary targets were key railroad stocks and copper companies, which were highly leveraged and extremely sensitive to the sudden withdrawal of credit from the financial system. This focused approach allowed him to maximize the impact of the bearish trend precisely in the sectors he knew were structurally weakest and most likely to collapse. By concentrating his capital on these few critical points, he created a massive, coordinated short position that became exponentially profitable as the panic accelerated and fear gripped the nation. The sheer size of his highly concentrated positions meant that every single point drop in the stock price translated into millions of dollars in instantaneous profit. While other diversified traders were losing small amounts across various unrelated portfolios, Livermore was maximizing his leverage precisely where the market pain was most acute and velocity was highest. This concentration of financial force allowed him to capitalize fully on the widespread fear, forced liquidation, and selling pressure gripping the market. The result of this strategic concentration was absolutely staggering, leading to one of the most legendary and profitable trading days in history. Livermore realized such an enormous profit that he was widely credited, by some accounts, with holding the largest single short position in the entire New York market. His profits grew so rapidly and were so substantial that they became a significant, noticeable factor in the liquidity crisis itself, demonstrating the sheer power of a single focused entity. The concentrated position created a dangerous feedback loop. As the targeted stocks collapsed under selling pressure, margin calls intensified across the market, forcing further liquidation, which drove the stock prices even lower. Livermore was expertly riding this self-reinforcing wave of forced selling, enabled by the massive size of his singular bearish bet. This level of market impact is fundamentally unattainable through diversification, which intentionally limits exposure to any single stock's catastrophic failure or success. The climax came when the legendary financier J.P. Morgan, attempting to halt the widespread banking failures and prevent total systemic collapse, had to intervene directly in the financial markets. Morgan realized that the continued aggressive short selling was severely exacerbating the panic and needed to be stopped immediately to restore public confidence and stability. He famously sent an emissary to find Livermore and personally asked him to cease his aggressive short-selling operations. Livermore, recognizing the gravity of the situation and the immense stabilizing influence of Morgan's intervention, agreed to cover his entire short book immediately. This decision cemented his legendary status, not only for the astronomical profits realized, but for the sheer scale and dominance of the concentrated position he controlled at the time. The profits from this focused bet transformed him overnight from a successful speculator into a multimillionaire. solidifying his financial foundation for decades to come. The lesson from the 1907 panic is absolutely incontrovertible and must be understood. The vast, life-changing profits were a direct mathematical result of concentration. Had Livermore scattered his capital across 50 different unrelated stocks, his overall return would have been significantly dampened by the less volatile or uncorrelated assets in his portfolio. Concentration enabled maximum leverage and maximum impact on the single strongest bearish idea he held with supreme conviction. This historical incident proves definitively that concentration is the essential engine of exceptional wealth generation in active trading, provided the underlying analysis is correct and execution is flawless. It shows that capital must be deployed aggressively and without hesitation when the conviction is highest, rather than defensively and thinly across mediocre opportunities. The ability and courage to deploy large sums on a single powerful idea is what separates the legendary speculator from the average risk-averse money manager. Another key historical example, albeit less dramatic than the 1907 panic, was Livermore's concentrated long bets during the roaring post-World War I bull market. He focused heavily on specific industrial stocks and commodity producers that he believed were poised to benefit most from the economic restructuring and rapid expansion of the era. Again, he did not buy the entire market through an index. He meticulously selected only the sectoral leaders and clear beneficiaries. By concentrating his capital on these leading stocks, he ensured that his portfolio benefited disproportionately from the strongest upward momentum and growth. If the general market index rose by 20% over a year, his highly concentrated positions in the leading stocks often yielded returns of 40 or 50%, or even more. This relative outperformance and alpha generation is the mathematical strategic advantage of adhering to the anti-diversification rule. Livermore's philosophy of concentration was also visibly reflected in his famous approach to commodities markets, where he frequently attempted to corner the market in single commodities like cotton or corn. While these large-scale operations were sometimes fraught with manipulative risk and complexity, they highlight his fundamental belief in maximizing impact through focused, singular capital deployment. He consistently sought control and maximum exposure in his best, most researched market ideas. In every single major success he achieved, the pattern was rigidly the same. Identify the overarching undeniable market trend, find the specific weakest or strongest point of attack, and deploy the vast majority of available working capital there. This overwhelming historical evidence confirms that Livermore did not avoid diversification by accident or laziness. He avoided it as a calculated strategic choice necessary to achieve exponential life-altering returns that diversification explicitly prevents. If concentration is the engine of exponential returns, why do modern retail traders and institutional managers alike avoid it so vehemently and preach against it? The primary barrier is fundamentally psychological, reinforced heavily by institutional indoctrination rooted in the principles of modern portfolio theory, MPT. MPT teaches that single stock risk is inherently reckless and must be avoided, regardless of the conviction level derived from meticulous analysis and research. This theory, which was originally designed for long-term passive investing and mass client management, prioritizes minimizing volatility and tracking error over maximizing alpha generation. Traders are constantly taught that any allocation above 5% to a single stock is financially irresponsible, conditioning them psychologically to fear the single inevitable failure. This institutional passive mindset fundamentally conflicts with the active speculator's goal of achieving exponential market-beating returns quickly. The modern retail trader is often psychologically paralyzed by the fear of the single, devastating failure of a concentrated position. Committing a significant percentage of capital, perhaps 30 or 50%, to one single idea, even when protected by a rigorously tight stop-loss, feels terrifying and overwhelming. The psychological weight of knowing that one decision could result in a significant portfolio drawdown often forces the trader to dilute their best idea across 10 inferior, mediocre ones. This pervasive fear stems from a deep-seated natural aversion to loss amplified by the constant exposure to market news warning against the classic danger of putting all your eggs in one basket. Livermore would argue that the basket should only contain one egg if you have absolute, verifiable certainty that the egg is gold and you have built an unbreakable, constantly monitored cage around it. The fear prevents the necessary conviction and commitment required for true speculative success. The direct result of this psychological barrier is the dilution of focus and capital into inherently inferior setups that lack the necessary edge. When a trader diversifies into 15 or 20 stocks, they are necessarily forced to allocate capital to positions that simply do not meet the high standards of a Livermore-style conviction trade. They trade quantity of positions over the quality of the opportunity, spreading their valuable resources thin across setups they are only moderately confident in, or even ambivalent about. This inevitable dilution results in predictably mediocre returns that barely outperform the baseline market index or often underperform it entirely. The substantial gains from the 2 or 3 genuinely good, high-conviction ideas are offset by the losses or minimal profits from the 10 or 12 average low-conviction ideas in the portfolio. The portfolio effectively becomes a self-hedging mechanism against the trader's own internal inability to commit fully to their strongest, most promising convictions. Consider the massive opportunity cost. If a trader allocates 5% to 20 stocks, they have 20 different complex positions to monitor, each demanding time, research, and emotional energy. If they consolidate that 100% of capital into 3 high-conviction positions, the focus improves dramatically, and the potential impact of the winners is magnified 5-fold or more. Diversification is often merely a substitute for the hard, necessary work of finding truly exceptional, high-probability opportunities that justify massive risk. The modern obsession with achieving low portfolio volatility often masks a fundamental lack of analytical certainty or conviction on the part of the trader. Traders use broad diversification as a psychological safety blanket, hedging against the possibility that their detailed analysis of any single stock might be fundamentally wrong. Livermore, conversely, saw diversification as a clear sign that the trader knew their analytical process was weak or incomplete, hence the perceived need for multiple backups. The actual cost of safety through forced diversification is the absolute forfeiture of the potential for exponential, life-changing growth. A portfolio that is meticulously structured to never experience high volatility also rarely experiences massive disproportionate gains that create generational wealth. The individual speculator is trading away the primary advantage they possess, agility and the freedom to concentrate capital, in exchange for the institutionalized comfort of low tracking error and mediocrity. Many retail traders genuinely believe they are mitigating systemic risk by broadly diversifying, but they are often simply replacing high single-stock risk with high correlation risk across the market. In a true systemic market panic, nearly all diversified portfolios collapse simultaneously and equally, rendering the diversification useless precisely when it is needed most for protection. The only genuine protection that matters is the ironclad, predefined stop-loss placed on the concentrated position. Livermore's concentration was always paired with a hyper-vigilant, non-negotiable risk management strategy that protected his core capital. He knew exactly where he was wrong before he ever entered the trade, and the stop-loss was always tight and strictly honored, protecting the overall capital base from catastrophic failure. The modern trader attempts to protect capital through broad, market-wide exposure, which fundamentally misunderstands the necessary surgical nature of true risk control. True risk management is not about spreading risk thinly and hoping for the best. It is about defining and controlling the maximum potential loss on the single highest probability trade identified. The fear that prevents concentration is the fear of accepting a substantial defined loss on one position, which is ironically the same total loss that might occur across a fully diversified portfolio during a systemic correlated market event. This fear paralyzes the ability to act decisively. Ultimately, the modern trader's reliance on diversification is a psychological hedge against their own lack of conviction and analytical certainty, masking fear rather than demonstrating strategic, aggressive risk management. To embrace the anti-diversification rule requires not just intellectual agreement with the concept, but the profound psychological fortitude to stand behind a single powerful analysis with maximum focused capital deployment and unwavering discipline. The anti-diversification rule is absolutely not a license for daily, reckless, impulsive trading. It is a specialized, sharp tool reserved exclusively for the rarest, most undeniable market opportunities. Livermore emphasized repeatedly that these big moves, which justify concentration, only occur a few times per decade, and the successful trader must be patient enough to wait for them. This requires long periods of strategic inactivity, careful conservation of capital, and the mental resilience to ignore the persistent, distracting noise of the daily market fluctuations. The ultimate prerequisite for the courage to concentrate capital massively is the demonstration of impeccable trade management and absolute, unwavering discipline in execution. The trader must know the exact exit point, the stop loss, before ever entering the position, and honor it without fail, regardless of any emotional distress or hopeful rationalization. Without this non-negotiable discipline, concentration is merely a fast path to certain financial destruction, turning justified conviction into catastrophic ego and ruin. The anti-diversification rule is not inherently dangerous or reckless in its design. Its danger lies only in the hands of the undisciplined or the underprepared trader who lacks conviction. It simply demands a level of analytical certainty, focused conviction, and psychological courage that most retail traders, conditioned by fear of single-trade failure and institutional mandates, are unwilling or unable to embrace fully. Mastering this rule is not about mastering the market. It is fundamentally about mastering the self. If you found value in dissecting the psychological and strategic depth of Livermore's concentrated methods, you will find immense benefit in reading the definitive text on his life and strategies. We have just released a new edition of the classic Reminiscences of a Stock Operator by Edwin Lefebvre, which offers a profound analysis of Jesse Livermore's psychology and aggressive market strategies. This special edition is supplemented with unique modern commentary and detailed chapter-by-chapter breakdowns, transforming his historical experience into practical, actionable lessons for the modern speculator. It is the essential guide to understanding the mindset required for concentrated success and the discipline needed for survival. So click the link below to get your copy and start applying Livermore's timeless wisdom today.